You've heard the one piece of advice everyone agrees on. Don't pick stocks. Don't try to outsmart the market. Just buy the index. 500 companies, one click, diversified, safe, boring, beautiful. And for decades, that was probably the best advice a normal investor could get. There's just one small problem in 2026. The thing people think they're buying, 500 companies spread nice and wide, has quietly turned into something else. Because today, roughly a third of the S&P 500 sits in just 7 companies. 7 out of 500. So the question is no longer, should you buy the market? The question is, what is the market actually made of now? Quick clarification because it matters. When most Americans say buy the index, what they usually mean is some version of the S&P 500. So that's what we're talking about. And it wasn't always like this. Back in 2015, the mega-cap giants were about 12% of that index. Today, it's 34. The index never changed its rules. The rules just quietly handed the whole thing to the biggest players. And here's the thing, the problem isn't really the S&P 500, the problem is the little formula hiding underneath it. It's not a conspiracy, it's math. Boring, mechanical math. The S&P 500 is market cap weighted. Fancy phrase, simple meaning. The bigger a company already is, the bigger the slice of your money it gets. You don't choose it, the formula chooses it. So picture what happens every time you get paid. Your 401k buys the index. The index takes your dollar and hands the biggest slice to the companies that are already the biggest. Then those companies rise. Their weight gets bigger, so next month they get an even bigger slice of the next dollar. And the next. It's a snowball with a ticker symbol. Size earns more size automatically while you're at work not thinking about it. Now here's the uncomfortable part. You probably think you decided to take this bet. You didn't. If your retirement is in a target date fund or an S&P 500 fund, basically any default option, a surprisingly large chunk of it is already riding on those same 7 stocks. Nobody sat you down and said, hey, a third of your US stock fund is riding on a handful of tech giants, and Nvidia alone is now big enough to move the whole index. It just happened, one automatic paycheck at a time. One of the loudest warnings about this came from a name you might know. Michael Burry. The guy from The Big Short, the one who bet against the housing market and looked insane until he didn't. Years ago, he argued that passive investing was damaging price discovery. Translation? When money buys the index automatically, less of it is asking the old-fashioned question. What is this company actually worth? Was Burry early? Very. Is early the same as wrong? Not always, but it does mean we should be careful before turning his warning into a prediction of a crash next Tuesday. Then there's the price tag. There's a measure called the Shiller ratio, basically how much investors are paying for a dollar of earnings, smoothed over 10 years. Its long-term average is in the high teens. Today, it's around 41. Readings up near 40 are extremely rare. Historically, they belong to only a tiny handful of moments, most famously the dot-com bubble of 1999, right before the market lost about half its value. And now. And to be clear, that doesn't mean stocks crash next month. Expensive markets can stay expensive for years. The Shiller ratio is a long-run gauge, not a stopwatch. But it does tell you what kind of price you're paying. And when the thing you're buying is both this expensive and this concentrated, safe and diversified starts to mean something very different. So why doesn't anyone freak out? Because just buy the index has been so good for so long that questioning it feels stupid. It worked through 2008, through COVID, through everything. So the idea that it quietly became a concentrated tech bet sounds like a guy with a cardboard sign. Until you open the actual fund you actually own. And the truly clever trick is that it doesn't even feel like a gamble. There's no casino, no flashing lights, no Wall Street bets screenshot. It's a beige website, a checkbox, and the warm word diversified. The most concentrated bet of your life, dressed up as the safest thing you've ever done. Now let me be the one to argue the other side, because this is where most doom videos cheat. Index investing is still, for most people, the smartest move available. It still quietly beats the majority of expensive fund managers who charge a fortune to underperform. Jack Bogle, the man who invented the thing, wasn't a fool. He was right for 40 years, and he's still mostly right. And those 7 giants aren't pets.com. They make real money, billions of it, with products in your actual pocket. A high valuation isn't fraud. It's just a high price. None of this is a scam. It's a side effect. But a side effect can still hurt you. Because when 7 stocks are a third of the index isn't really the market anymore. It's a bet on those 7 staying winners. If they keep winning, you're along for the ride. But if even a couple stumble, your safe, boring retirement fund falls harder than the word diversified ever promised. You took on the risk of a tech portfolio while being told you owned the whole economy. So, no, the answer isn't to panic sell everything and bury cash in the backyard. It's much less dramatic and much more annoying. It's to actually know what you own. Open the fund, look at the top 10 holdings, see how much of your future sits in 7 companies. Maybe you're fine with it. Maybe you want a little equal weight or something outside American tech. The point isn't fear. The point is that set it and forget it quietly became bet it and forget it. And you deserve to know you placed the bet. Because the most dangerous risk isn't the one you chose. It's the one you were told didn't exist. So next time someone says the index is safe because it's 500 companies, ask them one simple thing. Then why is a third of it just 7? If this made you look at your own portfolio a little differently, good. That was the point. Subscribe, and I'll keep showing you which money rules still hold up and which ones quietly stopped being true.